Happy Friday everyone, I'm Annie, and today is September 15th. I bring you two significant pieces of news. Firstly, today the People's Bank of China has once again reduced the reserve requirement ratio, commonly known as an RRR cut. This marks the second RRR cut this year, with a reduction of 0.25 percentage points, excluding financial institutions that have already implemented a 5% deposit reserve ratio. Following this cut, the rated average deposit reserve ratio for financial institutions is approximately 7.4%. You may be wondering what impact does an RRR cut have? In simple terms, it injects more liquidity into the market, influencing stocks, real estate, and exchange rates. Historical data reveals that since 2019, there have been 10 RRR cuts by the People's Bank of China. On the second day after these cuts, the Shanghai Composite Index rose 6 times and fell 4 times, showing a higher likelihood of rising. From a sector perspective, it generally favors sectors sensitive to liquidity, such as banks, securities, and real estate. Additionally, RRR cuts have had a positive effect on the foreign exchange market historically. Out of the previous 8 RRR cuts, offshore currency rates rose 5 times and remained stable once. Looking at the statistics, there are 60% chance of the Shanghai Composite Index raising. So, have you prepared for this potential market upswing? Then shifting to the next. This morning at 10 o'clock, the National Bureau of Statistics released economic data for August, and there are several key takeaways. Firstly, industrial production has picked up its pace. From January to August, the national industrial added value for large-scale enterprises grew by 3.9% year-over-year. In August, it increased by 4.5% year-over-year, 0.8 percentage points higher than the previous month. Secondly, there's an accelerated recovery in consumer spending. From January to August, the total retail sales of consumer goods increased by 7% year-over-year. In August, this figure surged by 4.6% year-over-year, a 2.1 percentage point increase from the previous month. Notably, the service consumption sector, particularly catering, saw an impressive growth of 12% in August. However, the growth rate of investment continues to decline. From January to August, fixed assets investment, excluding rural households, reached 32 trillion yuan, growing by 3.2% year-over-year but dropping 0.2 percentage point compared to July. In particular, manufacturing investment grew by 5.9%, rebounding for the first time this year. Meanwhile, real estate investment plunged by 8.8% year-over-year from January to August, amplifying by 0.3 percentage points compared to July, before the easing mortgage policy was implemented. In light of these statistics, the spokesperson for the National Bureau of Statistics pointed out that the international environment remains complex and challenging. The global economic recovery is weak, with rising protectionism, posing numerous challenges to international economic and trade development. Domestically, China's economy is recovering, but still faces issues like insufficient market demand and operational difficulties for enterprises. Nonetheless, China's economic resilience, potential, and viabilities are evident, and the international growth momentum is gradually strengthening. Recent movements in the forex and bond markets suggest that rational investors are anticipating China's economic revival. As for the stock market, given its complexity and structural issues, it may still face some challenges. In summary, after today's positive news in China, the offshore renminbi exchange rate against the US dollar rose about 7.26, with an intraday increase of over 200 points. Both A-shares and Hong Kong shares collectively rebound. What are your thoughts on today's data from China? Share with us on below and see you next week. Bye!